The S&P 500 is up 130 points or 3% since the beginning of June. Want to know more? Keep watching. Hello, I'm David and this is Trading Today. Yes, we've had a very good rally in the S&P, up 3% or 130 points above 4,300 as I speak, and that's all happened since the beginning of June. Now, we're coming up to a very big crunch week for investors. First off, we have the latest update on US CPI, the Consumer Price Index. That's coming on Tuesday. Now, headline CPI, which includes food and energy, is probably the figure that everyone is going to be watching. Bear in mind, last summer this hit a peak of 9.1%. It's now down to 4.9% and is expected to fall further to 4.1% when the figures come out tomorrow. However, it's core inflation which is proving very sticky, pretty much unchanged, and any kind of increase in that will be a concern for the Federal Reserve, who meet the following day. Bear in mind that the Fed's measure of inflation, core PCE, actually rose for April, and it was released in May. So this core inflation is going to be a concern. It's possibly one of the reasons why we haven't got a 90% probability of no change to the Fed funds rate at Wednesday's meeting. We now have a probability of 76%, and I think it's to do with concerns about what the CPI may show tomorrow. If it comes in as expected, if there's no particular jump in core CPI, then I reckon the odds will then favour the Fed leaving rates unchanged at 5.25%. But bear in mind, the Fed has raised incredibly aggressively since March last year. It has raised rates at every single one of its meetings, so this would be the first one, if it pauses, where we've had no rate increase. And we've gone from less than 25 basis points up to 5.25 basis points, and we have had effects in the market. We saw those bank failures back in March. So the Fed is going to be thinking about that. It's also, though, going to be thinking about what happened last week, where we saw the Reserve Bank of Australia, the Bank of Canada raise rates unexpectedly because inflation was showing signs of picking up, and we also had a warning from Swiss National Bank's chair, Thomas Jordan, again about inflation showing to be more persistent than expected. So although the Fed will want to probably pause and have a gap and see how their hikes are playing out so far, they obviously doesn't want to risk running into a recession because of these hikes in interest rates, but it's also concerned about a very tight labour market. We saw some evidence maybe that is loosening a bit, and that we are seeing some job losses increase. And although that's very bad news generally, that's what the Fed wants to see, because that will suggest that there won't be this rise in wage demands, which will play into inflation once again. So they may have a bit of a sigh of relief about that. But then again, perhaps just a couple of data points is too much to hang your hopes up. Perhaps they want to see more evidence that the labour market is cooling. Thank you very much for watching. I hope you found this of interest. If you did, please like and follow, and best of luck with your trading. Goodbye.